All right, we'll get started here in just a few minutes. All righty, it is 12 o'clock. My name is Allison Dutcher, and I am excited to be the host, for lack of a better term, of this amazing webinar that Aaron Staufer is going to be presenting today. Just a couple of quick things to note. After this presentation, this webinar, we will be sending you the recording of this hour and a half lunch and learn, along with the PowerPoint that you're going to be seeing. Any questions that you may have, please put any questions that you have, sorry about that, please look at the top of your screen and you'll see where it says Q&A and put in whatever questions you may have, and I'll make sure that Aaron is aware that you have a question, and I will make sure that it is presented to him and he will answer it. So with no further ado, I will happily let Aaron take it away. Thank you so much.
Awesome. Thank you so much. Thank you all for spending your lunch with me. A little bit about myself. So I've been in mortgages now for 15 years. Prior to that, I actually had my real estate license. So if you have a question, I will have an answer for you. When I'm not originating mortgages, which I do myself, when I'm not leading a team of loan officers and telling them how to do this job kind of as best as it can be done, I love to go on rides on my motorcycle with my sidecar and my dog Finian in the sidecar. It was a COVID-19 gift to myself. Just nice to see people smiling at that time. I also love to go scuba diving, love to go on hikes, love to play soccer as well, do yoga, and I'm a huge sports fan. So go Broncos, go Buffs. If you're a CSU Ramy fan, they're having a good year as well. But yes, all about the Broncos and all about the Buffs. That's a little bit about me. So the topic of our conversation today is beyond the traditional mortgage, okay? Really what we're talking about today is limiting reagents, okay? If you feel like you're in the wrong spot, you're not, I promise. So if you remember back to like grade school chemistry, right? You can run a chemical equation so many times until you run out of something. And whatever you run out of is the limiting reagent, right? Well, it's the same thing when you're qualifying for a mortgage, okay? When you're qualifying for a mortgage, my goal is to try to figure out what your limiting reagent is. For some people, it's their credit. For some people, it's their debt. For some people, it's their income. For some people, it's their assets. My goal is to figure out what our limiting reagent is, and if you want to qualify for more of a house, how we can maximize that limiting reagent, okay? Everybody's got a limiting reagent. Elon Musk has a limiting reagent. It's just his is much higher than ours, right? So everybody's got a limiting reagent. Our goal really is to try to figure out what that limiting reagent is. How can we maximize that limiting reagent when we're qualifying you for a mortgage? So we're going to be talking about the 3 C's, okay? When a mortgage lender qualifies you for a mortgage, we look at 3 different C's: credit, capacity, collateral. We're going to be going in that order, trying to figure out how we can maximize the limiting reagents along the way, okay? So credit. let's start there. It's everybody's favorite topic when we talk about mortgages, only because I feel like after college, you don't really get grades in life anymore. It's like the only grade you get in life after college is your credit score. So the credit scores we use are FICO, Fair Isaac and Company. That's what FICO stands for, FICO, Fair Isaac and Company. They try to standardize an algorithm to calculate credit scores. And specifically, we're on FICO Model 8. Okay. Within FICO Model 8, there's 5 different things that make up your credit score. Payment history is the vast majority of it, 35%. Amounts owed, what that really should say is amounts owed relative to the amounts you could owe. Okay. Specifically, they're talking about credit cards. What's your limit? What's your balance? You want to keep your balance to limit ratio to 30% or less, ideally. We're going to be talking about that a little bit more in a second here. 15% of your score is length of credit history. Okay. And then 10% is for new credit. That's really 2 different things. One, anytime a lender checks your credit, it's going to register as a credit inquiry. That's going to drop your score slightly. So that's considered new credit. Also, anytime you open up a new account, it's not going to help your score until you get 6 months history of that account, and then it'll start to improve your score. So 10% of your score is, has anybody checked your credit, and have you gotten any new lines of credit? And then finally, 10% of your score is types of credit used. For this, and this is kind of shocking, so please don't have a heart attack. For this, they say you should have 3 credit cards for every 1 non-credit card. Okay, so if you have a car loan and a student loan, you should theoretically have 6 different credit cards. Don't do that. It's only 10% of your score. It's a fairly small portion of the pie. Okay, we're going to be talking about how you can kind of maximize these different variables if your credit is your limiting reagent. Okay, so let's start with just general tips. Obviously, largest piece of the pie is payment history. Simply put, have you made your payments on time? Even if you were late on a payment, they will not report you late to the credit bureaus until you're 30 days late. Okay, so sometimes you're like, oh no, I had a late fee. I'm like, so long as you weren't a full 30 days late, that will not be reported late to the credit bureaus. So don't stress there. If you did have a 30-day late, the only thing you can really do is get current and stay current. Every month that goes by, your score will slowly start to improve once you've missed a payment or had a late payment of 30 days or more. So number 1 tip, obviously just stay current. If you have been late, get current and then stay current. Okay. Don't close any accounts is another general tip. So specifically, they're talking about this 15% of the pie, which is length of credit history. If you've ever heard somebody say, you shouldn't close out credit cards, they're specifically talking about this 15%, okay, the length of credit history. Anytime you close out a credit card, it's going to reduce your overall length of credit history. Credit cards tend to be your oldest accounts, right? Student loans, car loans, mortgages even. You're going to refinance, you're going to pay them off, right? They have a finite period of time, theoretically. Finite period of time, they will eventually get paid off in full and then disappear. Credit cards tend to be your oldest account. So credit cards are the single best thing you can do for your credit score if you're doing it responsibly. So length of credit history, if you were going to close out accounts, my advice to you from purely a credit score perspective would be, if you're going to have to close out a credit card, close out the newest credit card, okay? Keep your oldest account open. It's going to be the single biggest benefactor of your credit score, because the length of credit history is 15%. That's not nothing. That's a pretty significant chunk. Keep credit inquiries to a minimum. Again, we are talking specifically about this portion right here. Anytime a lender pulls your credit with the intent of extending credit, okay? There's a couple exceptions to this, but with the intent of extending credit, it's going to drop your score between 3 and 5 points each time. It's going to affect you for about 90 days, okay? Now, I mentioned exceptions. There's really 2 exceptions. If you're shopping for a car loan or if you're shopping for a mortgage, so long as they do a credit inquiry within 14 days of one another, you'll hear a lot of misinformation on this. It's 14 days. That's straight from FICO's mouth, okay? 14-day window. You hear some people say 45 days, 30 days. Don't listen to them. It's 14 days, okay? 2 weeks. So long as multiple mortgage lenders or multiple car loan lenders pull your credit within a 14-day window, it only counts as one inquiry. It's called non-deduplication. The government did not want to punish you for shopping around for the best car loan rates, for shopping around for the best mortgage, okay? So there is that exception, car loans and mortgages. It does not apply to credit cards. If multiple credit card lenders pull your credit, they're going to assume you're trying to get access to multiple lines of credit, multiple credit cards, okay? Not the case with car loans, not the case with mortgages. So keep your credit inquiries to a minimum. It does have a fairly minor impact, again, 3 to 5 points, and it only affects you for about 90 days. So it's minor and it's temporary as long as you're limiting the number of inquiries, okay? 3 to 5 points can add up over time. So again, you want to kind of keep that limited. All right, well, these are just general tips. But given time constraints, Is there any quick ways to improve a score? Yes, absolutely. And we're going to be talking about this portion right here, 30%. So, constraints. Paying down credit cards is the single biggest way and single quickest way to improve your credit score. Okay. Ideally, you want to keep your credit card balance relative to your limit to 30% or less. Ideally, you never want to utilize more than that. Okay. I say ideally because it can be rather tricky. If you have a store card, right, like a Kohl's card, well, you only have a $300 limit, right? It's going to be very hard not to creep up over 30% if you're actively using that account. So there's a couple different things you can do here. But if you have time, pay down that card to less than 30% of your available limit. Now, people always ask the question, well, I pay off my credit card in full each month. That doesn't actually matter, okay? Whenever that credit card statement generates and that gets sent out, that's the information that has already been passed along to the credit bureaus. So if you're like most folks and you're like most mere mortals and you don't pay your credit card until your credit card bill comes due, by then it's actually too late. Okay, that information's already been passed along. So if you're like a lot of people and you get it for the miles, you rack up a balance during the month, you creep up over 30% or 50% of your limit, and then you just pay it off in full once the bill generates, that information's already been passed along, your credit score has already negatively been impacted. So there's a couple things you can do, okay? Number one, you could pay it down right away. If we're passive about it, if we waited 30 days, that updated information would get passed along, your score would be reflected. Okay, so if we're just passive about it, you paid it down, after 30 days, you're going to notice improvement in your score. Like I said, very quick way to improve your score, 30 days in this case. Or we can do what's called a rapid rescore. A rapid rescore, which is where you send us information saying, hey, that information on the credit report's incorrect. Here's the updated balance and the updated payment. We can take that directly to the credit bureaus, have the score updated. Instead of having to wait 30 days, we can get a new score in about 5 business days. Okay, so it's very, very quick. Lenders are not allowed to pass that charge along to you either. So from your perspective, at least, it's free. Cost the lender some money, kind of cost of doing business from our perspective. Like I said, if you already pay off your cards in full, it doesn't matter. That information's already been passed along to the credit bureaus, okay? So there's a couple things you can do. One, never utilize more than 30% of your limit, okay? Definitely don't utilize more than 50% of your limit. Once you go over 30, your score is going to start to drop. Once you go over 50, your score plummets. So we tend to notice around this time of year, November, December, people rack up larger balances on their credit cards because of the holidays, traveling, gifts, so on and so forth. And we tend to notice the lowest credit scores existing in December or January because of this exact piece, okay? So you can make sure that you're utilizing more than 30% of your limit. May or may not be easy. Or if you have a very small limit, simply increase that limit. Again, if you have a small store card and you want to use it more often, see if you can increase the limit. It will count as a credit inquiry, so it'll impact that new credit, that 10% of your score, that yellow slice that we talked about. But it'll be harder to then creep up over 30% of your limit, and certainly hopefully harder to creep up over 50% of your limit at that point. So if you have a small limit, you want to use that card, see about increasing the limit on your account. That would make it less likely that you'll creep up over 30%. The downside risk to that, well, one, we talked about the credit inquiry. 10% of your score, 3 to 5 points, they're going to want to check your credit before they extend the limit, right? The only other downside is if you don't trust yourself, okay? If you are somebody that, hey, look, if you give me a higher limit, I will use that higher limit. This does assume kind of financial responsibility, right? That you can manage your books and take care of things as you need to take care of them. So quick tips to improve your score. If you notice like significant swings in your credit score, inevitably it has to do with this chunk. 30% of your score is simply amounts owed relative to the amounts you could owe. Keeping your balance to less than 30% of your limit is going to be the single biggest way to improve your score. One last note on this. So each credit pull report we do is good for 4 months, okay? So long as you close within that 4 months, we will not have to do a new credit report. However, lenders are now required to do a credit refresh within 10 days of closing, okay? We have to do that to make sure that you have not gone out and bought a brand new car that's now showing up on credit, okay? We also need to find out who's checked your credit since we started. And we have to get a letter of explanation from you with regards to why they checked your credit. Oh, I was shopping around for a mortgage for the best deal. No problem, okay? Well, I was at Home Depot and they were having a Veterans Day sale and I wanted to buy a new washer and dryer for my house. That's a problem. We do not have that new account on your credit report. We have to add that new account to the credit report, okay? So once we pull credit, once you're under contract on the house, try to keep people checking your credit to a limit because we are going to find out a week before closing And if you have gotten any new accounts, we're going to have to add that new account to your credit report. So you're going to have to be doing some, rather significant hoop jumping at the very last second, which nobody wants to be doing when they're worried about packing up and moving and all that other stuff, right? We do not get a new credit score. People are always worried about that. My credit score is perfect, but now I've had people check my credit as I was shopping for a mortgage. What happened to my credit score? We actually don't get a new credit score. We just see who's checked your credit, how have your balances changed, and have you gotten any new loans? Okay. So don't stress too much on that part, but be careful because we will find out if somebody else checks your credit. Capacity. So we talked about credit. We're going to talk about capacity right now, which gets down to two different pieces. Okay. Debt to income ratio, as well as down payment. We're going to start with the debt, which is the first part of the debt to income ratio. So when there's an installment loan, okay, installment loan has a finite period. A car loan is an installment loan. Personal loan is an installment loan. Student loans are installment loans, except, the term has been extended and extended and extended. And so all of these are installment loans. Again, we're talking about how do we maximize the limiting reagent? How do we maximize the piece that's going to limit us, okay? This is actually kind of a nifty way to do so. If you have a car loan or a student loan or a personal loan or some kind of installment loan, we have to take that payment showing up on credit against your debt to income ratio, okay? Unless, and this is a big unless you have less than 10 payments remaining. If you're purchasing a car, this does not work for a car lease. They assume if you have a car lease, you're going to renew the lease or go get a new lease. But if it's a car loan purchase, you don't have to pay off that debt entirely to get it off your debt to income ratio when we do the income analysis, okay? You simply have to pay that thing down to less than 10 payments remaining. If there's less than 10 payments remaining, the government says lenders can ignore that debt. We don't have to factor that in at all. So I've got folks that are like, got this pool of money to be used for a down payment, but I also have this debt out there. Like, where should I apply the money? I'm like, do nothing yet. Once you apply it somewhere, we can't get it back. So do nothing yet. Let's get credit pulled, and I can run the various different analysis to figure out exactly how we can get the most bang for our buck. Maybe it is paying down a car to less than 10 payments, but you're not going to have to pay it off in full. So really, really important. We've saved people, thousands of dollars before because we were planning on paying off this car in full. Car loans tend to have better rates than mortgages. So if I can have you not pay off that entire car loan to qualify for a higher price point on a house, I'm all for it. So again, if you have a car loan getting close to being paid off, you might not have to pay it off entirely for us to ignore that debt. If it's a car loan purchase and there's less than 10 payments remaining, I get to ignore it entirely. Let's talk about student loans, which are a big topic right now, okay? So with student loans, it's constantly changing. It's constantly changing. I've been doing this. I got into lending originally in 2011 at Elevations. Prior to that, we were actually at another institution, and that was backdating until 2009. So I've been doing this for a long time. Student loans have changed probably more than anything else has. It's constantly changing, okay? Right now, the policy is whatever payment's being reported, we can use for qualification, unless it's in deferment, okay? If it's in deferment, we have to calculate a payment as though you are currently making payments. And the payment they have us use to calculate, if we're going with Fannie Mae, it's 1% of the balance of your loan. So $100,000 is going to show up on paper as $1,000 per month. That's significant. If we're going with Freddie Mac, they have us do 0.5%. So it'd be $500 in that same example. Still significant. So if you are currently in deferment, okay, and I cannot qualify you at 0.5% or 1%, I might ask you to get your loans out of deferment early, okay? Because if they're out of deferment, whatever payment is being reported in your credit report is the payment I get to use for qualification. I've had doctors before with $250,000 in student loan debt, and their payment showed up on credit report with $1. I joke you not, I was able to use $1 against the debt to income ratio calculation, okay? So sometimes it's better to, hey, get that out of deferment, go on to income-based, IBR, right? Or IDR, income-driven repayment, okay? They'll look at how much your student loans are relative to how much you make, and they'll calculate a payment based on that. Sometimes that's the way to go. Sometimes that gives us the absolute rock bottom low payment. If you're making a lot of money, maybe that's not the way to go. Maybe I have you do extended repayment plan or a standard repayment plan, okay? Most of those repayment plans are going to be a little bit less aggressive than the 1% that Fannie Mae would have us use to calculate against your debt to income ratio. So again, moral of a lot of the story is don't do anything in advance, okay? Don't take your money, apply it towards paying off a car loan, That car loan might not be holding us back, okay? Don't take your loans immediately out of deferment, but be prepared to start pulling on these levers as we start to work through your personal situation to figure out what you can qualify for, what do you want to qualify for, and how can I help you get there, right? That's the entire point of this class. How can I help you get where you want to get to? Here's the different levers that we can pull, okay? How about credit? So when it comes to credit cards, personal lines of credit, home equity lines of credit, whatever payment is showing up on the credit report, again, we get to use. Now, that's going to be the minimum payment on your statement. Get this question all the time. I've got a credit card, but I pay it off in full, so I pay literally thousands of dollars each month on my credit card. Don't stress about it, okay? You're not required to make that payment, therefore I don't have to count that payment against you. If you have a $10,000 per month on your credit card, but your minimum payment is only $150, I get to use that $150 for qualification, okay? So don't stress about the entire balance. All we get to do is count the minimum payment against your debt to income ratio when we do the debt to income ratio analysis, okay? Again, minimum payment, that's what I get to use for qualification purposes. So again, if we need to maximize this, right? If this is a lever we can pull, right? How best can we pull it? Well, have you pay off your account before that bill generates. It works. It works also improving your credit score, right? Because whenever that credit card statement generates, that's the information that gets passed along to the bureaus. Well, if you pay off your credit card before that credit card bill generates, that's the information that gets passed along, okay? So that's another way you can kind of get ahead on the credit score. If your credit card bill comes due on the 1st, great. Set a calendar reminder to log in on the 25th of the month, pay off that credit card in full like you normally were going to, right? Now when that credit card bill comes due, it's going to show $0 balance, $0 payment. That's what's going to get calculated in your debt to income ratio. Also, it's going to have the side effect of, hey, $0 balance, $0 payment. That's what gets reported to the credit bureaus. And that's going to give you a better credit score as well, keeping that balance to limit ratio at less than 30%. So 2 birds, 1 stone, just requires a little bit more work on your end. Credit cards are the single best thing you can do for your credit score. Not only do they tend to be around the longest, I've got folks that have had credit cards open since the 80s, right? You get a new credit card every few years, it's still the same credit card account, right? So I've got folks that have had credit cards open since the 80s. That has an impact on your credit score. Managing that balance, keeping your balance to limit ratio to less than 30% consistently shows a level of discipline that an installment loan does not. Balances are changing, payments are changing. Car loans, you kind of set it and forget it, right? So credit cards do show a level of discipline that other accounts don't have, which is why credit cards are the single best thing you can do for your credit score. I've got folks, and I mentioned, kind of at the outset, there's a 3-to-1 ratio. Theoretically, you should have 3 credit cards for every 1 non-credit card. Don't necessarily do that, right? But I've had folks that only have installment debt, student loans, car loans, maybe a mortgage, and their credit score is always limited. They can never get up over a certain level. It's because they're missing that credit card. Credit cards do show a level of discipline so long as you use them responsibly that other accounts do not show. So keep that in mind. If you don't have a credit card and you were to ask a credit repair company, hey, how do I improve my score? The first thing they're going to do is tell you to get a credit card. Credit cards are the single best thing you can do for your credit score. Equity lines of credit. So some lenders, and if you get this response, you should hang up and call somebody else, including elevations, okay? Some lenders, if you have a home and you've got a second mortgage on that account, it's a home equity line of credit, they might calculate a payment on that home equity line of credit, even if there's no balance currently outstanding. That's a problem. Home equity lines of credit are typically like $100,000, right? They're significant amounts. So if a lender's calculating a payment against your home equity line of credit, even though you don't currently owe anything, you really should be talking to a different lender. They have what's called an overlay, okay? So these are all kind of Fannie Mae and Freddie Mac guidelines. Fannie Mae and Freddie Mac guidelines are the ones say, hey, that minimum payment on your credit card is what we get to use for qualification. Hey, if you pay down an installment loan to less than 10 payments, we get to exclude that debt, right? These are all Fannie Mae and Freddie Mac rules. They are the government-sponsored enterprise behind the mortgages. An overlay is a lender saying, hey, look, that's all fine and dandy. We're going to take our own requirements and layer them on top. We are overlaying our requirements on top of the government's guidelines. So if you're getting this kind of response of, oh, you got a home equity line of credit, but we're going to calculate a payment against you, that's an overlay, okay? They have a requirement above and beyond what the government requires. What about using a home equity line of credit as an asset? We're going to talk about that in a little bit here. So this is the debt side, right? Talked about credit cards and student loans, installment debt. Let's talk about income, okay? So people always ask, hey, if I'm a W-2 employee, my gross before deductions and taxes might be one amount, but I whittle that down because I'm contributing like a 401k, maybe a 403b, maybe an IRA. Like I'm whittling my income down as much as possible so I don't have to pay taxes on as much money. Don't stress. Okay, we get to use the gross income prior to any deductions when we calculate our debt to income ratio. Okay, so please do not stress about any retirement contributions or taxes or any of that stuff. Medical expenses, like we get to simply go off of the gross wage. Okay. If it's a full-time hourly or salary position, we get to use 100% of it immediately. Okay. We do have to show that you're qualified to do the job that you're doing. By that, I mean, if I was in mortgages, right, and I decided, hey, look, for my next career, I want to go into be a chef, right? And I just quit elevations to go become a chef. I would not recommend you go to that restaurant. But if I was in a position and I was trying to apply for a mortgage, the lender would immediately ask, hey, how are you qualified to do that job, given that your history is not in that job? Maybe I went to culinary school. I would have to show a certificate showing that I completed culinary school. Maybe I went to school originally for it. I would have to show my college transcript showing that I originally went to culinary school. Okay. You just have to show that you're qualified to do the job that you're doing. Okay. Just because I was a successful originating sales manager doesn't necessarily mean I'm going to be a successful chef, right? So I just have to show that I'm qualified to do the job that I'm doing. 2-year work history is going to be required. However, they will include schooling in that 2-year work history. So you going to school for whatever you're currently doing now is considered part of that 2-year job history. Being a student is considered a job. Okay, so please don't stress on that either. You will notice I say full-time hourly or salary. We're going to talk about part-time in a bit here. Part-time does require a 2-year history. Any variable income, okay, is going to require a 2-year history. Variable income. That would be commissions, bonuses, part-time, seasonal employment. In Colorado, we get a lot of seasonal employment. Yeah, I work at the, DIA. I don't think it's called DIA anymore. We work at Denver International Airport, during the summer as a baggage handler. And then during the winter, I work the ski slopes as a ski instructor. That's considered seasonal employment, right? That's fine. We do have to, again, have a 2-year history. So if it's any kind of variable income, we have to have a 2-year history, including self-employment, okay? They carve out one exception. And by they, again, I mean Fannie Mae and Freddie Mac. They do carve out one exception. So they say, hey, look, we want to see a 2-year history of self-employment. We can get by with as little as 1 year of self-employment if it's an industry you have experience in and you're making more or equal to what you were making before. A great example of that is engineers. Okay, we'll have some engineers that are W-2 salaried employees, and then they become a 1099 contractor for the same company so they can handle their own deductions, so they can handle their own retirement contributions, so they can go out and get more clients than just the one, right? Perfectly fine. They've got history of it. They're making hopefully more or equal to what they were making before, and everything is just fine. So 2-year history, as little as 12-month history, if you're making more than you were before and it's in an industry you were working in prior. Okay. Now, here's the tricky part with self-employment. We're going to be taking a look at this next. Tricky part with self-employment is, don't want to offend any self-employed borrowers. I've been there myself when I was a real estate agent. Self-employed borrowers are renowned for saying, oh yeah, I made $500,000 last year. That sounds wonderful. Awesome. Great. How much did you pay taxes on? Oh, well, I had $300,000 in deductions. Okay, you really made $200,000 from a lender's perspective, okay? When you're self-employed, you're responsible for your own expenses, right? So you could sell $500,000 worth of goods, but if all the materials to sell those goods cost you $300,000, in reality, you really made $200,000. Self-employed borrowers are renowned for having a lot of deductions to reduce their taxable income. All fine and dandy until you try to get pre-approved for a mortgage. One wonderful tip and trick, especially this time of year. There's a reason why they said, hey, what class do you want to teach in November? And I said this one, okay? It's for this exact reason, because I love this time of year. I can tell people, hey, look, January is right around the corner. You can do a draft of your tax returns as early as you possibly can in January and send me a copy of the draft of the return. Don't hit send, don't hit file, do a draft of the returns. When they're in draft status, I can look at the analysis, the income, and give it to a self-employment income analysis and say, hey, look, based on these numbers, I can qualify you for this. If you want to get here and you're currently here, you might need to limit some of your deductions. Now, people are like, well, isn't that kind of gaming the system? Trust me, the IRS would love nothing more to collect more taxes from you. So yes, but the IRS is happy with it, and Fannie Mae and Freddie Mac are also happy with it. Okay, my job is not to help you commit fraud. My job is help you pull on the levers to maximize the various different reagents, in this case, try to maximize our limiting reagent. So if you are self-employed, yeah, maybe you have to pay a higher tax bill for a year or two if it means qualifying you for a mortgage and getting you into the house you want to get into. So once they're filed, we're kind of stuck with them. Yes, you could go back and revise them, but it gets pretty ugly and murky at that point. So if they're in draft status, send it to me. I'm more than happy to take a look at it, let you know what you qualify for. And if you're trying to get somewhere else, I can let you know what leverage you can pull on to do that as well. Okay. You likely are either Schedule C, which is considered a sole proprietor, or you likely have an LLC or an S Corp. Okay. I'm going to be showing you quickly the analysis lenders will do to calculate your income. Okay. So when you're self-employed, we start with the net income. So we're going to start with like line 31 down here. Okay. So that's where we're going to start with. We're then going to add in a few deductions. Okay. We get to add in business use of home right here, line 30. We also get to add in depreciation over here on line 13. We do have to subtract out 24B, which is your meals and entertainment. Okay, so we get to add in depreciation, we get to add in business use of home. Go hog wild with those deductions. I can add all that stuff back into the equation. Okay, I do have to subtract out meals and entertainment, like I said. So that's the calculation lenders will do. If the income is increasing, we'll typically take a 2-year history of it, a 2-year average rather, sorry, unless the business has been alive for 5 years or longer, and then we typically only have to use your most recent year of income. Okay. If you are an LLC or an S Corp, okay, we're going to look at things slightly differently, okay? We're going to start with box 1 from your K1, which is going to be your ordinary business income. If you also paid yourself a salary, we get to add that into the equation as well. Sometimes the distributions down here on line 19 are more than the ordinary income. We might be able to use this larger amount, but only if we can show your business is liquid. Okay, it's a little bit of a complicating piece of the puzzle. Showing your business is liquid means we have to pass a liquidity test. Okay, so we're going to look at Schedule L. We have to show that your company has more assets than liabilities. Okay, so we want to make sure that these numbers equal a larger number than the very bottom here. Here's the logic. Okay, you could be taking money from your business, which is distributions, for a couple different reasons. Okay. You could do it because you didn't pay yourself as much as you should have. Okay, that's a possibility, right? Hey, I only paid myself $100,000, but my company made $150,000, so I just took it from the businesses. That's one possibility. You could also be paying yourself forward. You could have been stockpiling cash in years past, and now you're taking money from the company, also potentially allowed. Or you could be doing the opposite, right? You could be receiving less money than you might have expected, and start to draw down the business accounts to compensate for that. That would be a bad thing. You would not pass the liquidity test. And if we can't pass the liquidity test, I cannot use that. Okay. So they may or may not be able to be used. The simplest way to calculate income is simply the box 1 of the K1 plus your W2 wages. Same drill. Okay. 2-year average of that, so long as it's increasing. If it's decreasing, they're going to want to use the most recent year. If it's decreasing by more than 20%, we're going to have to validate to the underwriter why that's the case and why we don't expect that to continue. Okay, so self-employment does admittedly get a little bit more complicated. We do a lot of self-employment loans, a lot of them. So yeah, for that, kind of same drill. Like, don't necessarily do anything right off the bat. Apply for a mortgage. Let us get your tax returns. Let us help you through the analysis and find out exactly where we stand before you decide to change anything. Like I said, 2 years of self-employment. If you've been self-employed for at least 5 years, we can usually get by with 1 year. Also, expect to have to provide a profit and loss. Okay, so profit and loss. What is a profit and loss? A profit and loss is a statement. If you just Googled profit and loss, don't do it just yet, but if you Google profit and loss, you'll see a lot of image examples. But it has your company name at the top. It's got the date range that we're asking for. It's got your income sources. And then below that, it's got your expenses. And typically, we'll have you do the expenses in a similar categories as your tax returns. Hey, I've got car and truck expenses. I've got advertising. I've got, my office expenses and this, that, and the other, rent or lease, whatever the case may be. So we'll have you break down your expenses in similar categories. And then you're going to have your net income, okay, which is your income minus your expenses. Okay. What they're looking for if they ever request a profit and loss is that income is similar to what you made historically, in the previous year, there's exceptions for that. I had somebody earlier this year, they were in landscaping, right? Well, great. I was talking to them in April. Yeah, landscaping is going to be pretty quiet January through April. That's not a problem. We know that's a seasonal job. I had somebody that worked in sprinkler repair. Yeah, it's totally a spring, summer, fall job, right? So don't stress about it if your numbers don't line up exactly. This late in the year, they should be awfully close, right? Through November, unless you're in snow removal and we haven't gotten your, second portion of the money making year for you. Unless you're in one of those kind of niche jobs, the numbers so far this year should track average with what they were the previous year. What they're looking for is stability, generally within 20%. Okay, if we're within 20%, we're in pretty good shape. If we're outside of 20% and it's decreasing, we're gonna have to explain to the underwriter why that's the case. Maybe you bought a lot of stuff and you're ramping up your business. Maybe you had to step away because you had a child. Like there's plenty of reasonable explanations for that. They just need to make sure that the income's not going to continue to decrease into nothing. Okay. I mentioned variable income. Again, if it's bonuses or commissions or tips, we need to show a 2-year history of that income in order to be using it for qualification. Bonuses, commissions, tips, that can all vary pretty drastically. The only way the government feels comfortable calculating income from those sources is if we have a consistent track record of it, okay? If you do receive tips, make sure you're claiming those on your tax returns, okay? Some businesses are really, really great. They issue your pay stub. It even has the tips broken out on there. Wonderful. Other times it's, hey, under the table, here's some cash tips. If you're not claiming those on your tax returns, I cannot use it for qualification purposes. That's a big one, okay? I had a bartender many years ago. He received a lot of cash tips. He never claimed any of it. I'm like, look, if you want to buy a house, you're going to have to go back and revise your tax returns for the last couple of years. That's exactly what he did. He went back and revised 2 years of tax returns, ended up paying a pretty big tax bill to the IRS, but he was able to qualify for a house and get into a house. He's still in that house today, actually. So sometimes it's worth it, but if it's tips, make sure you're claiming it on your tax returns if you're trying to qualify for a mortgage, if for no other reason than that. Okay. Bonuses, we're able to use those, again, if there's a 2-year history, so long as it's not decreasing significantly. Again, typically 20% is what they're looking for. Increasing, great, no problem. Decreasing, so long as it's not decreasing by more than 20%, should be okay with that as well. Commissions, same as bonus income. Keep an eye out for non-reimbursed business expenses. So even if you're a W-2 employee like myself, if you're pure commission like myself, you might have some extraordinary expenses above and beyond paying for, paper or computers or whatever. You might be paying for some marketing out of your own pocket, right? Or mileage, right? Stuff that your company does not reimburse you for. It used to be, and the government's eased up on this a little bit, it used to be if you're commission based, they would want to see what your non-reimbursed business expenses were and figure out how much of a percentage of your income it is. And if it's too significant, they could actually deduct that. They've gotten a little bit more lenient. They don't typically look at that anymore. But if you're in a pure commission job, it would not surprise me at all if they ask for it at some point. So keep an eye on that, especially if it doesn't impact your taxes you pay at the end of the month. When you're at the end of the year, when you're doing TurboTax and it says, hey, do you have any non-reimbursements? And you fill out this entire thing and you look at it and you're like, hey, it didn't change my tax bill at all. Great. Maybe don't put that down then. If it's not impacting your tax bill and it might limit how much you can qualify for a mortgage, maybe you forgo that part. All right, let's talk about rental income. Allison, no questions yet.
I don't have any questions as of right now, no.
Please, if you think of any questions, drop them in the Q&A. Allison will come back on screen. We'll field them. Feedback we get constantly is that the questions people ask are even more useful than what I have prepared. So please, 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 if you have a question, somebody else likely has the same question. All right. So let's talk about rental income. So if you have a rental property, okay, it'll show up once you file your tax returns on your Schedule E. E for Edward, okay, Schedule E. How we're going to calculate your rental income is we are going to look at your net income, so line 21, okay? And then once again, just like self-employment, there's a number of deductions we can add back in. People are always worried about this. I had somebody earlier this week even say, hey, look, I have a rental property, but it shows up consistently negative. I'm like, don't stress about that at all, okay? There's a number of write-offs I can add back into the equation. I can add in depreciation. I can add in interest on your mortgage. I can add in your property taxes, your insurance, your HOA dues. If you have HOA dues, I can add all that back into the income. And then what we're going to do is we're going to divide it by 12 to come up with the net rental income each month. Okay. If it's a newly acquired rental property, or it does not show up on the tax returns yet because you've only rented it out, this year. okay, and you just haven't filed your 2024 tax returns yet, for instance. So long as we have a signed year-long lease, I get to use 75% of that lease amount to offset the mortgage payment you currently have. Couple things in that statement, okay? 75%, not 100%. Why would that be the case? Well, the government's logic, and again, all these loans are backed by the government in one way or another. The government's logic is, glad you have a tenant in there, but what if you didn't find a tenant for a few months between leases? So they have what we call a vacancy factor of 25%. Shave 25% off the top, start there, subtract out the mortgage fee. Other thing you'll say, notice I said is to offset your housing expenses, your mortgage payment, okay? I get to use that income to offset the principal and interest, the taxes, the insurance, the HOA dues. I do not get to use it as additional income until it shows up on your tax returns on your Schedule E. Okay, it's really, really important. Typically in that situation, you're planning on converting your current house into a rental, buying a new house. Great, I can use 75% of that rental income to offset your debt. I can't use it as additional income going forward. What if you don't have a housing payment? Sorry, it doesn't count as income until it shows up on the tax returns from a lender's perspective. With regards to qualification, if you're converting a current residence into a rental and we need the rental income to qualify, I need a signed year-long lease. Has to be a signed year-long lease. The lease must go into effect within 45 days of closing. And again, I get to use 75% of the rental income. I always feel like an example helps. So let's say I'm living in a property right now. We'll call it property A, okay? And I want to go buy property B. But like most folks, I'm going to struggle to carry two mortgage payments, property A and property B. How do I offset my debt on property A so that I can go buy property B? It's a very common situation, okay? Well, once you go under contract on property B, I would start to advertise property A for rent. Put it on Craigslist, put it on Zillow, ask a property management company to get involved, whatever the case may be. My goal, once I'm under contract on property B, is to find a tenant for property A. Signed year-long lease is what I want. I also want to get a hold of the security deposit and first month's rent check. And that lease would have to begin within 45 days of my closing date on property B. So if I was closing on property B on December 1st. December 1st, nice and easy, right? Great. I would have to have a lease that begins no later than January 15th, within 45 days of closing on that new property. I then get to use 75% of that rental income to offset that debt. Now I'm qualifying for hopefully one mortgage payment instead of two. Has to be a signed year-long lease. We have to have the lease in your file by your loan termination deadline, also known as loan availability deadline. So I basically have typically 2 to 3 weeks to find a suitable tenant, have them sign a lease, have them give me their security deposit, first month's rent check. Closing is typically around 4 weeks from when I go under contract to when I close. And loan availability or loan termination deadline is typically about 2 to 3 weeks into that process. So it seems like a lot. Can be a lot, but we've certainly seen it executed many, 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 many times. You just kind of have to be prepared for it. Have the pictures that's ready, get ready to hit, save on that listing. And it can also be easier sometimes the year than others, right? It's trickier in November, December when people are planning for holidays and nobody really wants to move. You also just don't see that much tenant turnover in the winter. You see a lot more tenant turnover in the spring and summer. All right. This whole seminar is about maximizing your limiting reagent. What if you're newly retired? Constantly comes up. The two hardest times in life to get qualified for a mortgage is when you're newly self-employed, because a lender wants to see at least 12 full months of that income to qualify, and when you're newly retired. When you're newly retired, you're probably not using your assets like you probably will be at the end, okay? You're probably living in rather conservatively. You're only taking how much you need to take if you're taking required minimum distributions, but you're living pretty conservatively and you're kind of living on your assets. Allison, question, woohoo!
Yes. I just had a comment. There was a person saying that they thought this was going to be about non-traditional loans. I thought that it would be things like FHA loans or first-time home buyer loans. So I didn't know if you wanted to add any clarification
we're
there.
definitely going to begin to some non-traditional. Those are actually both very traditional loans. First-time home buyers, you can put as little as 3% down instead of needing 5% down. That is a first-time home buyer program. That's also backed by Fannie Mae and Freddie Mac. So it is as traditional of a mortgage as they get. FHA is actually a little bit of another traditional loan. It's actually a low credit score program. FHA used to be limited to first-time home buyers. Now FHA is really limited to low credit score programs. Conventional financing, everything we've been talking about so far, requires a 680 or above credit score. If you're below a 680, we are definitely looking at FHA, Federal Housing Administration. It is actually Uncle Sam's money. It has higher costs, both monthly and upfront. It also requires 3.5% down. As a first-time home buyer, conventionally requires 3% down. Okay, so FHA really is a low credit score program these days. It's almost exclusively used for low credit scores. We will be talking about other, like if we're going beyond the scope of conventional financing or FHA, what are the options available? We will be talking about that in a few slides here. So hopefully that helps, but we definitely can get into it as well offline if you have any specific questions. More than happy to get into it. But yeah, really, we're trying to figure out how we can maximize your reagents within the general parameters of conventional financing, FHA financing, VA financing. All of this would kind of apply across the board. We'll also be talking about what if you simply don't fit any of these parameters? What else is available? Got that for you in a little bit here. Newly retired, hard to qualify for a mortgage. You're not taking as much from your assets as you could. Here's a great trick. These are all tips and tricks, right? This is a great trick. If you are of retirement age and you have a 401k or an IRA, I can have you set up recurring distributions from that 401k or IRA, receive one distribution prior to closing, so long as I can show it's set up on recurring. And if I show 3 years of continuance, I can now use that income to qualify you for a mortgage. That's huge. That's huge. All the time I talk to retirees where they're like, yeah, I don't receive a lot of income, but do you have assets that you could receive income from? Oh yeah, sure. I've got a 401k and an IRA. Heck yes. I can have you set up recurring distributions for significantly more you're currently receiving. Receive one distribution prior to closing, so long as that income can continue for up to 3 years. So heck, if you're receiving $1,000 a month, I have to show $36,000 in that account, right? 3 years worth of that income. Now I can use that for qualification instead. It's huge, absolutely huge. I have retirees qualifying left and right for homes that they shouldn't be able to qualify otherwise. This is a wonderful trick to be able to qualify folks for the house that they're trying to get into. I've got another member that I'm trying to connect with right now. They've got significant retirement assets, but they're not receiving a lot of income from it because they don't need to. Well, now they want to qualify for a significantly higher house, more expensive house until they sell their current house. Great. This is a great trick. This is exactly what we're going to be looking at. Asset depletion, okay, or also known as asset dissipation, okay, asset dissipation, asset depletion, okay. It allows us to create an income stream from assets, retirement, or otherwise to qualify for a mortgage. So if you're heavy in assets, but you don't have a lot of income, we can use asset dissipation or asset depletion to calculate an income stream. For a conventional route, again, Fannie Mae, Freddie Mac backed loan, they're going to have us divide your assets by 240 to come up with an income stream to qualify. If we're looking at a portfolio loan, which we're going to be talking about a little bit more here, this is like the complete non-traditional, hey, you don't qualify one way or the other, like that's going to be the path we're going to look at. They will take your assets over 120 months. So a more liberal, for lack of a better term, path to calculate your income. It gives us more income than otherwise would be. Fannie Mae and Freddie Mac are very conservative. Elevations when it's on personal money, we may or may not be more liberal. What about for a down payment? Ultimately, for closing, you want your funds for closing to get into a liquid account, savings, checking, money market. Okay, you're going to have to wire those funds to the title company for closing. You're going to have to get a cashier's check for closing. So ultimately, you want your money in a liquid account for the money that's being used for closing. We do have to show 2 months of account statements on any assets we're using to qualify for a mortgage. Large deposits come up all the time, okay? If you have a large deposit for more than 50% of your gross monthly income, I have to find out where those assets came from, okay? Sometimes people try to get a little too creative. They're like, well, you know, my 50% of my gross monthly income is $2,500. I'm just going to do multiple smaller deposits for $500. No, if the total adds up to more than 50% of your gross monthly income, they're going to ask you where that money came from. If they think you're trying to skirt around those rules, there's underwriter discretion involved. They're going to ask you where that money came from. So be very upfront and honest with us. I'm on your team. The lender's on your team, right? We're trying to help you get into the house you want to get into. So just be upfront and honest. I had people before, they sold a lot of stuff at a garage sale, and now they just deposit that money in their account. They were trying to qualify for a mortgage. Like, unless you have a paper trail of you bought a couch and you sold a couch, do you have title work to that couch? How can I prove that the cash you deposit in your account is from that sale, right? So paper trails are really important. Copies of checks, all that's going to be super helpful. Okay. If you have a large sum of money you need to deposit in your account and you're not going to have a paper trail for it, okay. I've had people before where they're like, yeah, I've got a safe at home. It's got $40,000 worth of gold in it. I'm like, number one, where do you live? Just joking. But you need to sell that gold, get a deposit in your account, and you need to season the funds, okay? Not salt and pepper seasoning, right? Seasoning the funds means the funds are in your account for at least 2 full months prior to going into the contract. When you go under contract, I ask for the most recent 2 months of bank statements. Anything that happened before that is not my business, okay? So if you do have large deposit you need to make, deposit in your account, wait 2 months, and then go under contract or try to go under contract on a house, okay? If it's deposited within 2 months of going under contract, I had to find out where the money came from. If you have cash, put it in your account, okay? Wait 2 months. If you have precious metals at home, sell those, deposit them in your account. If you don't have a paper trail on where the funds came from, you really need to season those funds, okay? Get a deposit in your account, wait 2 months, and then apply for a mortgage. What about gift funds? Gift funds are perfectly fine when you're buying a primary residence. It has to be a relative, past relative, or a familial-like status. So fiance, adopted children, ex-family also counts. So your ex-husband could give you money for the purpose of buying a house. Maybe they want to keep their family in the house, right? That's perfectly fine. We do have to have a gift letter completed, so you and them would both sign it. We also have to show the transfer of the funds occurring. If the funds go to you, we have to show the transfer of the funds leaving their account, arriving in your account. If they send the funds directly to the title company, we just have to show the wire receipt showing the funds came from their account. I had somebody recently, they're like, oh, well, it's, my partner, not my fiance, familial like status is kind of iffy, but they just want to contribute their portion of the funds to buy the house. I'm like, it's all fine and dandy, but since all these loans are backed by the government in one way or another, they want to make sure the house is not being purchased with dirty money. Kind of weird, but that's exactly what they're worried about. They are worried about somebody selling drugs and then buying a house with drug money. Meanwhile, the government has financed the house using drug money. Okay, that's their worst nightmare. So if this seems like overkill, you might not be wrong, but that's why they want to do it. They want to make sure whatever money is being used for closing was received from legitimate means. You can also get a secured loan. Okay, if you have a car and you don't have a loan on that car, you can do a cash out refinance on your vehicle. Okay, you can actually put a loan on that vehicle, take that money from that loan, and use that to buy a house. We used to come across that all the time for first-time home buyers. Haven't come across it as much anymore. But that's a totally viable option. You can use a secured loan. Another secured loan would be a home equity line of credit. Okay, with a home equity line of credit, you have a house, you have a lot of equity built up in your house, you can take a loan against that equity and use that to buy a house. Okay, we do have to count that new payment in your debt to income ratio, and we have to show the deposit from that new loan into your account. Okay, so expect to have to provide loan paperwork showing what the new payments are going to be. Expect to have to document the paper trail showing the funds arriving in your account and where the funds came from. What about bridge loans? So we're starting to enter the less traditional section, right? My goal is if we have all these traditional loan products, conventional financing, FHA financing, how can we fit you inside those guidelines? How can we maximize whatever is going to ultimately limit you? Now we're to the more off the beaten path portfolio products, okay? A bridge loan is one such portfolio loan. There's no secondary market for bridge loans, okay? Bridge loans used to be very, very, very popular. Pre-2008. Pre-2008, bridge loans were everywhere. They would go up to 100% of what your house is worth. They didn't have to worry about having a qualifying payment associated with it. They might have had larger fees. They might have had no fees at all. It's a portfolio loan. Whenever it's a portfolio loan, the lender themselves get to dictate how much they will lend, what the rates, what the costs are, all of that. Okay. So a bridge loan solved the issue of how you take equity out of the house and buy the new house with that equity. But they were highly leveraged. They would go up to 100% of what your house is worth. What could go wrong there, right? And they were only supposed to be used for a few months. So the loan terms were really, really short. Might have been a 6-month loan or a 12-month loan. Pre-2007, when houses were flying off the market, not a problem. 2008, housing bubble pops. All of a sudden, 100% loan to value became 105% loan to value, 110% loan to value, created a lot of issues with delinquencies. They were also only meant to be used for a few months. When the housing bubble was popping, homes were sitting on the market for 6 months, 12 months, multiple years even. So loans that were highly leveraged and only meant to be used for a couple months were sitting on the loan market forever as values were decreasing. It led to a high rate of foreclosures and short sales. Okay. So lenders had to kind of pivot. Okay. So bridge loans kind of went the way of the dodo bird for the longest time. They disappeared. Okay. I heard they're trying to bring the dodo bird back. That's kind of crazy. Anyways, bridge loans went the way of the dodo bird. And also, like the dodo bird, they're starting to come back. Okay. So home equity line of credit have started to be used for in place of bridge loans. Couple differences. Okay. They will no longer go up to 100% of what your house is worth. They'll go up to like 80% of what your house is worth. So value of your house times 0.8 minus how much you currently own your first mortgage, that's how much you might be able to get access to. Okay. We also have to qualify to carry 3 mortgage payments, assumably. Okay. Your first mortgage on your current house, transitional HELOC is what we call it, transitional home equity line of credit on your current house for the down payment money, and then a first mortgage on the new house as well. So we have to qualify to carry 3 payments. We're a little bit more flexible when it's a portfolio loan. We say, hey, look, we know you're going to sell that house. We have a listing agreement even showing you're going to sell that house. So we feel a little bit more comfortable with it. We'll go up to a higher debt to income ratio threshold than the government typically will. The government typically will limit you to about 45%. Okay. If we show that the house is going to be sold, we can typically go up to 60% as a portfolio loan. So we have more flexibility on our own personal book. If we can qualify to carry 3 payments, even if the debt to income ratio is higher, if you have enough equity in your house to be able to access this, this is a great option to look into. Allison, question.
Yes. Is there a market for buying a house from people that are being foreclosed on or were foreclosed on?
Question. So call that, at least in my industry, we would call that a bank-owned property. Okay, property is in the process of being foreclosed on. In that situation, a true foreclosure is going to go to auction. Okay, a true foreclosure is going to go to auction. They're in trouble. They're going to be selling their house, or the lender's going to be selling the house on their behalf, and it's going to go to auction. The issue with that is that those all have to be purchased with cash. They don't really tell you that. When you are buying a house through auction, you have to pay cash for that house. Kind of eliminates most buyers. Okay. In this area, admittedly, Colorado Front Range, a large quantity of homes go for cash. But when you're buying a house truly on foreclosure, it is going to be a cash only transaction. You're not going to be able to get financing on it because they don't want to deal with financing. A more common route would be a bank owned property. So a borrower is going through a foreclosure. The bank is going to take possession of that asset and then sell that asset. That you could get financing on. One of the first homes I ever bought was in 2010. That was a bank-owned property. Okay, the bank was purchasing own that house, and the bank was actually the one selling it. At the time, it was Bank of America that was selling that home. I bought that house through Bank of America. So it depends where you're getting at in the process. Is it a true foreclosure, in which case it's on auction, in which case it's going to be cash only, or is it a bank-owned property? If it's a bank-owned property, you can get financing on that. It would follow pretty typical conventional guidelines, typical conventional process as well. A little bit of a change is that you're dealing with the bank, so you're going to be signing a different contract. In Colorado, most transactions are done with a standardized state contract. It's like 27 pages. Every year, the Department of Regulatory Agencies releases a new one. When you deal with a bank, just like when you deal with a builder, you're going to sign their own personal contract, not the state's contract. So that's one slight difference. Also, it's going to be a little bit of a lengthier process. But yes, that's absolutely an option potentially. We haven't seen a lot of foreclosures because the market has been still fairly hot from a seller's perspective. It would not surprise me at all, unfortunately, to see that change. Consumer savings rate is at extreme lows. Consumer spending is at like an all-time high. Interest rates have not helped out anybody either. So it wouldn't surprise me at all to see that change. But those are kind of the 2 distinct processes: actual home foreclosure, auction, or bank-owned property. Allison, another question.
Yes, just to clarify, when you want to buy a different house before you sell your house, you would use the HELOC, but you would have to continue your current mortgage payments and cover the new HELOC payment?
Until you sell your current house, yeah. And you just hit the nail on the head. Some folks feel really comfortable with that. They're like, oh, I've got plenty of money saved aside. I can afford to pay 3 mortgages for a number of months before, times are going to get tough. Other people are like, 3 payments scares the living, out of me. So be it. Not right for everybody. I will also say that once you close on a house, you will skip your next month's payment. So if you close today, November, 19th, you will not have to pay a December payment. Your first mortgage payment is not due until January 1st. Now, hope for the best, but plan for the worst. You still need to plan on, hey, what if January 1st rolls around, my house has not sold. I've now got 2 payments on that house and 1 payment on the new house to worry about. Yeah, you absolutely need to be making sure that you're budgeting accordingly. Very good question. Great questions, great questions, great questions. Transitional HELOC, again, not for everybody. It's our solution to the bridge loan problem. We'll go up to 80% of what your house is worth, not 100%. We do want to show that the house is going to be sold. So we do need to show a listing agreement showing that the house will be hitting the market within 30 days of closing. They're not in this forever. They want to make sure that you have plans and intentions to actually sell your house. So most lenders will only do a home equity line of credit on a primary residence or second home. Elevations will actually do them on investment properties too. The rates are higher, but we will absolutely do a home equity line of credit on an investment property. We will also not go up to 80% loan to value on those. On a primary residence, if it's not a transitional HELOC, we'll actually go up to 90% loan to value. On an investment property, they're going to cap those at 75% loan to value. So higher rates, more conservative loan to value. This is important. It's going to come up later. Okay, we're going to talk about collateral and how you can kind of house hack when it comes to collateral, okay, the property you're buying. A primary residence is defined as a property you intend to live in for the next 12 months, okay? So if you're looking to buy a new primary a year from now, you might want to get a home equity line of credit now, okay? There's a $75 annual fee on it, so you might have to pay a $75 annual fee. But once you turn that house into a rental, or once you say, hey, look, I'm no longer planning on living in that house for the next 12 months, it is now considered an investment property, even if you're currently living there. It's a really important distinction. So a home equity line of credit, it's really nice to have it if you're not going to use it because it gives you access to a large sum of money if you did need it, okay? Better to have it and not need it than need to not have it. That's kind of right. Only downside is, again, there's a $75 annual fee. So it kind of depends on, is the convenience to having a home equity line of credit worth $75 a year to you? Some people say yes, some people say no. From the hierarchy of interest rates, car loans are typically the best, then it's first mortgages, and then it's going to be home equity lines of credit as the third best. Then it's a pretty significant gap before you get to all the unsecured debt. Unsecured debt, credit cards, personal loans, student loans, all that's unsecured, right? It's not tied to an asset. So unsecured debt is always going to have a higher rate than secured debt, car loans and mortgages. What kind of credit terms look like? These are those terms, okay? It's a variable rate, attached to the Wall Street Journal prime rate. For best credit scores, which is 740 or above, it's going to be the Wall Street Journal prime rate plus 0.24. So those are going to have a rate of right around 7.99 today. There's also a fixed 20-year loan as well. Rates will vary depending on credit score as well as loan to value, combined loan to value. CLTV means combined loan to value. So your first mortgage plus the HELOC is at 80% or less of what your value is, or 90% again. HELOCs, you only pay in what you owe, just like a credit card. So if you have a home equity line of credit for $150,000 and you have a $0 balance on it, you're not going to have to pay any interest on that loan. It's great for doing renovations to your house. It's great for consolidating debt if it's a higher rate debt, credit card debt especially. Closing costs are pretty nominal. If an appraisal is needed, they're going to be around $700. If an appraisal is not needed, only about $150 to $200 roughly. Elevations will cover the first. Sorry, that's changed now. It's $250 instead of $500. There is a $75 annual fee on those as well. If you have any questions on second mortgages, hit me up. All my contact information is on the last slide. I've got a nice succinct email that kind of summarizes all this for you. All right, so let's talk about some other non-traditional loans. Okay, a home equity line of credit is a non-traditional loan. There's no secondary market for it. Okay, let's talk about other non-traditional loans. One loan you'll hear about is 3% down with no MI. So again, 3% down is a first-time homebuyer program. That is a government-sponsored enterprise, Fannie Mae, Freddie Mac, first-time homebuyer program. Okay, well, 3% down with no MI. Here's what they're doing. With a conventional loan, you can either do monthly mortgage insurance or one-time mortgage insurance, but you don't have to pay both. Okay, FHA, you have to pay both. Conventional, you do not. Okay, conventional, also, mortgage insurance is temporary in nature. Talk about the ways you can remove mortgage insurance on the next slide. FHA, your mortgage insurance is permanent. Okay, if you put less than 10% down, if you're going FHA, you're probably doing less than 10% down. If you're going FHA, putting less than 10% down, you're going to have it forever. The only way to get rid of it is to refinance into a conventional loan. If you put 10% down or more down, you only have to have mortgage insurance for 10 years with FHA. FHA, again, its sphere of influence has really been shrunk and shrunk and shrunk some more. It is really now a low credit score program almost exclusively. Okay. So what is 3% down with no MI? What a lender is doing is they're doing one-time MI instead of monthly MI. Okay, so a larger one-time fee. The lender is then increasing your interest rate sufficient to give you a lender credit to cover that mortgage insurance. Yeah, if you're rolling your eyes at home, that's the right maneuver. Instead of giving you mortgage insurance, they're increasing your interest rate for you. Okay, so instead of having the temporary mortgage insurance, you now have a higher rate for the life of your loan. Not great, right? You might have a lower monthly payment initially, but you're going to have a higher rate for the life of the loan, whereas mortgage insurance can be temporary in nature. Because of all this, we don't hear a lot of this. This was something that lenders used to throw out a lot. 3% down with no MI. And then once they caught wind what was going on, they're like, wow, that's a terrible deal. And it's really not for the customer's benefit. Yeah, it's kind of a marketing play almost exclusively. So we don't see a lot of that. It is still an option. We certainly offer it. But make sure if you're hearing something like that, 3% down with no MI, make sure you're asking questions because inevitably they're probably charging you a higher rate to cover the cost. Mortgage insurance with a conventional loan, there's 4 different ways to do so. Okay. Number 1, it'll fall off when you're scheduled to reach 22% equity. It's when you're scheduled to reach, not when you do reach. If you put 5% down, it's typically about 10 years in the loan when mortgage insurance would naturally fall off. That's like the worst case scenario. Okay. That's you make your payments on time, you fall asleep at the wheel and naturally fall off at that point. Number 2, you can refinance at any point if you have 20% equity. When you refinance, you're not going to have it on the new loan. That's actually pretty likely right now. You're going to hear a line in this market that you marry the house, but you date your rate. The expectation is, hope is, that when you buy right now, rates are elevated, 30-year fixed around 7%, right? You're going to be refinancing in the next few years as rates are expected to drop. The latest expectations that rates are going to be in the low 6s next year. Fingers crossed. We've been admittedly saying that for about a year and a half now. So really, really hope that's the case. But if you do refinance and you have 20% equity, you don't have to have mortgage insurance on a new loan. Number 3, within the first 2 years, if you actively pay down your loan and you reach 20% equity based on the original value, okay? That's the key word here, original value within the first 2 years. It's not how much your house is worth at that time. It's the original value, which is the lesser of the contract price or the appraised value, whichever one of those 2 numbers were less. Vast majority of the time, those 2 numbers are one and the same. Within the first 2 years, they'll only use the original value, not any appreciation. Number 4, also a very common route, okay? After the first 2 years, you can petition to have it removed based on a new value, the appreciated value, but you have to have 25% equity in the house. Why 22% equity in the first scenario or 25% equity in the fourth scenario? One thing I know of all insurance companies is they want their money. They also don't want to be like a California market where, hey, values increase drastically one month and then they drop drastically the next month. So they build in a little bit of a buffer to kind of compensate for that. What a lender doesn't want is they don't want you to petition to have mortgage insurance removed, have the value go down, and then all of a sudden should have required mortgage insurance for longer because now your loan to value is above 80%. So those are the various different ways to remove PMI. Number 2 and number 4 are by far and away the most common right now. Especially number 2, we're really, really hoping the rates come down and people can start to refinance out of these loans. What about avoiding mortgage insurance altogether? Another non-traditional loan, okay? You can do what's called a piggyback loan or a combination loan, okay? An 80-10-10 is another term for that. So it's an 80% first mortgage, 10% home equity line of credit, and then a 10% down payment. These used to be very, very, very common. Very common, okay? It's an easy way to avoid mortgage insurance, and people hate mortgage insurance. However, the government caught wind. The government caught wind that people were trying to avoid mortgage insurance, and their combined loan to value was above 80%, okay? So they said, hey, look, well, you can still do an 80-10-10, but if you're doing 80-10-10 and you're avoiding mortgage insurance, we're going to charge you a higher rate on your first mortgage now. We consider it higher risk because it doesn't have mortgage insurance present. Mortgage insurance protects the lender from higher defaults, okay, from higher loan to value defaults. So having an 80-10-10, we don't have that mortgage insurance involved. Instead, we have 2 different loans. One's at a variable rate. What's going to happen there? So they just said, hey, look, these loans have higher risk, therefore they're going to have a higher rate on their first mortgage. The second the government changed that, 80-10-10s basically dropped off the face of the earth. We do very, very few. I do a lot of loans in Colorado. We only lend in Colorado. But 80-10-10s are very, very uncommon now. They used to be all the time, everywhere. They're very uncommon now. All right, so let's talk about some hacking real fast with regards to collateral, and then we're going to get to a couple different current market trends, and then looking at like portfolio loans as well, kind of put a bow on all of this. So let's talk about collateral. When we're looking at FHA financing or conventional financing, we're talking about 1 to 4 units. Okay, so single family homes, townhomes, condos, duplex, triplex, and fourplex. Okay, anything more than 4 units is considered commercial in nature. Anything less than 1 unit, so vacant land, is also considered commercial in nature. Now, if it's a 5-unit complex, how is that commercial in nature? It's a great question. Commercial is a complete misnomer. Okay, commercial does not mean you are buying a food truck. It does not mean you're buying storefront and you're selling bagels or pizza out of it. Okay, commercial is a catch-all for anything that's unconventional. Less than 1 unit, vacant land or construction loans. More than 4 units, 5 plexes and above. Okay, all that falls under the general umbrella of commercial financing. Commercial financing is a completely different animal. Okay, the running joke is commercial lenders laugh at what we do on the conventional side, and we laugh at what they do because it's completely different from one another. Okay, expect shorter term loans, expect higher rates, adjustable rate mortgages, sometimes balloon payments. Balloon payment is where they say, hey, you've got a 10-year loan, but after 5 years, you owe us all our money back. Okay, it's a 10-year loan, but really it comes due in 5 years. All of those are very common features of a commercial loan. It's also very common for them to do continual reviews of your loan. Analyze your income documents every year, make sure that you qualify to carry on the new loan, reapprove you for it. It's very common to do all that. If you do have questions on commercial front, please contact Todd Payak. He's our VP of Commercial Lending. He'd be happy to talk to you. He'll probably ultimately send you to one of his commercial loan officers, but he's a super smart guy, been doing this forever. I do joke with folks all the time that I'm an indoor cat. Conventional lenders tend to be indoor cats. We're in front of our computer. We're working on numbers, right? We're living in our office. Commercial lenders are totally outdoor cats. So call them if you have any questions. If you don't get a hold of them, call them again a day or two later. You are not pestering them. Outdoor cats sometimes need to be brought inside. So just bring them inside. All right, so let's talk about being clever with collateral, okay? There's not a lot of ways to be clever with collateral. Conventional financing, FHA financing, they're very concerned about health, safety, and livability concerns on homes. We cannot use rental income from a primary residence. We get that question a lot. Hey, I own a 3-bedroom home. I'm one person. I rent out my other 2 bedrooms. Can I use that income to help me qualify? Not typically, unless it's border income. Border income is where you might have like a mental or physical disability and somebody lives with you to take care of you, but they also pay you rent. In that situation, we may be able to use border income, but it's very infrequent that we can. There's one exception to that. Duplex, triplex, and fourplex. We do get to use the income from the other units to help you qualify. I had a buyer the other day. They're like, hey, look, I'm looking at like $250,000. I'm like, I can qualify you for that. They're like, what if I was looking at a duplex, triplex, or fourplex? I'm like, well, duplex specifically, it jumped the price up from $250,000 to $400,000 because I could use that additional rental income to help us qualify. So it is one exception that we can use rental income from a primary residence if it's a multi-unit home. Another way to be clever with collateral, and I really like this, okay? So there's 3 different types of properties, okay? Primary residence, second home, and investment property. Primary residence, you sign a document at closing saying, I intend to live here within 2 months of closing, 60 days, and I intend to live there for 1 year, 12 months. That's all you're agreeing to. Once you've lived there for 12 months, you've lived up to your end of the bargain, okay? I will also emphasize the word intention, okay? Intend. I intend to live there. I had somebody that bought a home. They're planning on moving into it. It was their intention to live in it. Then they had to relocate for work. They lost their job unexpectedly. They had to move to Wisconsin. They never moved into the house. They did not commit loan fraud. It was their intention to live there for a year. Circumstances changed. They were not able to do so. They did not commit loan fraud. They turned that house into rental. No loan fraud occurred. It was their intention. All we can go off is your intention, okay? Second home. It's a property that's significantly far away from your current residence. You intend to live in a part of the year, and your primary intention is not to rent it out. Again, your intention is not to rent it out. That doesn't mean you can't rent it out when you're not there, but your primary intention is not to rent it out. Significant distance. Every lender will have a slightly different opinion on this, but typically we go by 40 miles. Okay. They also carve out an exception if it's geographically different enough. Okay. If you're buying a house anywhere in suburban Colorado along the Front Range, right? And you're buying a second home in like a mountain town, ski town, perfectly fine. It's automatically going to qualify as geographically different enough. Unless you're moving from the mountains to the mountains, not a problem. If you're moving from suburbia to, buying a second home in, Steamboat or Beaver Creek or whatever, perfectly fine. It's geographically different enough. It would qualify as a second home. Okay. Otherwise, it has to be significantly far away. Defined as typically 40 miles or more. An investment property is a property you purchase with the intention of renting it out. Okay. I mentioned all of this because this is a really clever way to house hack. Okay. I used it myself. It's wonderful. Okay. I bought a primary residence. I lived in it for 12 months, converted into a rental, bought a new primary residence, lived in it for 12 months, converted into a rental, bought a new primary residence, converted it into, I accumulated 3 properties over the course of 3 years, each time buying a new primary residence, converting the primary residence into a rental. What's the advantage of that? Well, as a primary residence, first-time homebuyer, you can put 3% down. Woohoo! If you're not a first-time homebuyer, you have to put 5% down. Still not a big deal for most folks, right? If you're buying an investment property, you have to put 20% down. And most investors find they have to do 25% down to make the numbers work. In addition, the rates are significantly higher for an investment property or a second home. The government's found out if times get tough, you're more likely to skip payments on a second home or an investment property than your primary residence. You're more likely to evict a total stranger than you're going to evict your, significant other yourself, right? So higher risk, higher rates. To get the best rates, to get the lowest down payment, great. Primary residence is kind of the way to go. Okay. So super easy way to house hack. You have to live a little bit of a nomadic lifestyle, right? Admittedly, this kind of came to an end when my wife and I got married. Can we stop moving, please? Yes, of course. But it's a great path if you are limited with the down payment, which tends to be the largest hurdle to buying investment properties. Super simple life hack. One qualifier here. Each move has to make logical sense, okay? You cannot move from a 250 square foot, 1 bed, 1 bathroom condo to another 250 square foot, 1 bed, 1 bath condo. I had somebody execute this. They bought 4 properties in one complex. But they started on the ground floor studio apartment. Then they moved up to this next floor up and they bought like a 1 bed, 1 bath. Then they moved up to a 2 bed, 2 bath. And then they bought to this penthouse suite. But they bought literally 4 properties in one complex. Each time it made logical sense. Okay. We just have to show, are you moving closer to work? Are you getting a larger space? Are you right sizing because you have too much space currently? Is it closer to the kids' school? Is it closer to your work? Is it a better neighborhood? Does it have a larger yard? Does it have a garage? We just have to add some kind of benefit to it. Okay. And so long as we can do that, this totally works. All right. Let's talk about the times. So a number of different things are kind of unique about the market that we're currently in. Appraisal gaps, we are still seeing that occasionally. Houses right now are either sitting on the market for a lot longer than you'd expect, or they've got so much demand and there's multiple offers on them. Okay, so an appraisal gap is where you say, hey, look, I know the market has kind of been, relatively stagnant from an appreciation perspective for the last 12 months. So your house might not appraise for what I'm willing to buy it for. Okay, I'm acknowledging that I will cover the difference. Those are not coming up quite as often as they were at the very beginning of COVID. During COVID, everybody first shuttered themselves in their house, and then they realized, oh my gosh, this house is not big enough, and they started to all kind of enter the market simultaneously, right? So they used to be very, very common during COVID-19, very beginning of COVID-19. It was kind of frothy. Everybody was kind of stepping over each other to get their offers accepted. Appraisal gaps were coming up on almost every single transaction. Now it's relatively uncommon. I'd say we're only seeing them on about 5% of transactions right now. An appraisal gap is you saying, though, if my house does not appraise, I will come up with additional funds for closing to cover that shortfall. A lender is only going to use that appraisal value to base your loan to value on, the lesser of that or the contract price. Okay, so if your appraisal value comes in lower, we're going to have to reduce our loan amount most likely to compensate for that lower value. An appraisal gap is you saying you'll come to closing with the difference. Quicker closings, that's still a piece of our market. Okay, it used to be pre-COVID. Typical closing was like 30 days, very, very common. During COVID, everybody wanted to close as soon as possible. We got that time frame down much quicker. I would say that has not changed at all. That's still right around 3 weeks. 3 weeks is very typical from contract to closing. We can move even closer than that. The quickest the government will let us close is 8 days from going under contract to closing. Okay, 8 days. That's calendar days, not business days. 8 full days. I've closed numerous transactions in 8 days this year alone. What can be done to expedite things? Rush appraisal. You throw extra money at the appraiser, they can turn around those appraisal reports quicker. That certainly helps. How else can you make your offer stand out? Lenders matter more than usual. Okay, it used to be, again, pre-COVID, the lender did not matter. Anybody could get a deal done. It did not really matter who you use. Sellers weren't in a position to be really picky. It's still technically a seller's market. Sellers control more of the leverage than they normally do. And with that, your lender matters a little bit more. If you come with an out-of-state lender, yeah, they may or may not push back on you. It kind of depends. It kind of depends on how many offers they have. If they've got multiple offers, the seller can be picky. They're likely going to demand a little bit more from you. So the reputation of the lender, offers matter. How quickly they can close matters. Can the lender put in a call to the listing agent? So are they working over the weekend so they can call the listing agent and talk you up? I do that on almost all transactions still. It still makes a huge difference. Another process is you can go through underwriting in advance. It's called credit, income, and asset approval. Okay, so we actually get all your income and all your asset documents, credit pulled, and we actually send your loan through underwriting in advance. That'll allow us to kind of shortcut things a little bit more, close a little bit quicker. It also allows me to let the listing agent know when I call them, hey, we've already got credit, income, and asset all approved. All we need is collateral because we need title, an appraisal, and insurance on the house. As soon as we get those 3 things, we're good to close. Just gives that seller a little bit more of a warm, fuzzy feeling that this offer is really a good one. Buy-downs. So temporary rate buy-downs used to be exclusively used for new construction. It was a way for builders to entice people to come into their offices. Hey, come look at our new construction homes. Oh, by the way, the lender's paying to reduce your rate temporarily for the first couple of years. Okay. Well, when rates are elevated, as they currently are, when the expectations that rates will come down, as they are, and when the market is a little bit more balanced, as they are currently, all of a sudden temporary buy-downs started to be used in the broader market as a whole. They come in a lot of different flavors. There's a 3-2-1 buy-down, a 2-1 buy-down, a 1-1 buy-down, a 1-0 buy-down, a lot of different flavors. Okay, but a temporary buy-down is where the seller typically will pay to reduce your rate temporarily for the first several years. 2-1 buy-down is still by far and away the most common. It reduces your rate effectively 2% for the first 12 months, 1% for the second 12 months, and then third year and beyond, you'd have a static normal monthly payment. So it lets you kind of ease into your mortgage payment. It's a way for the seller to incentivize you to make an offer on their house. It also makes it a little bit more manageable given elevated rates. We did not see this when it was an entirely seller's market. Why would the seller pay to reduce your rate for the first couple of years? Yeah, they're not gonna. Take it or leave it. We got people lining up out the door. Now, a little bit more balanced, all of a sudden you might be able to ask for a little bit more than you were able to in the years past. It only makes sense to do it if the seller is willing to pay for, if not all of it, at least some of it. And the reason I say that is because you could pay for your own temporary buy down, but it would literally be me taking your money, setting it aside into a separate account, and then supplementing your mortgage payment with that money. Well, you could do the exact same thing, right? Then why have the lender do it when you can do it? Fair. So it really only makes sense to do it when the seller is going to do it for you, when they are paying to do it. It's a great way to get your rate down, to ease into your payment, take advantage of that money. The other really nice thing with the temporary buy down is if you go to refinance a year from now and you still have money in that buy down account, whatever money's left over gets applied towards your loan balance. So there's no way for you to leave money on the table. Eventually, you will see the entirety of that benefit. Super, super handy. We do these all the time. Had a closing yesterday where this agent accidentally negotiated too much credit. And I was like, oh no, what do I do? So I just threw on the 1-0 buy down. I just reduced their rate effectively, 1% for the first 12 months. Their payment dropped $350. They were ecstatic. Like, hell yeah. Very creative, Aaron. You betcha. I gotcha. So it's a great option. All right. So talked about maximizing credit, capacity, your debt to income ratio, your income even. We've talked about current collateral conditions as well as just the general times. What if everything I've covered and you're still like, none of this fits me? None of this fits me. I still don't fit into these nice tidy boxes. Even if we're trying to manipulate these variables along the way, I still cannot fit inside these boxes that the government has carved out. We want the debt to income ratio to be 45%. We want the credit score to be over 680. What else can be done? Broad strokes, The answer is portfolio loans, okay? So everything I've talked about is going to be applicable for two of the three types of loans out there. There's conventional financing. Those loans are backed by Fannie Mae and Freddie Mac. There's government financing, USDA, U.S. Department of Agriculture, VA, Veterans Affairs, FHA, Federal Housing Administration, actually government money. And then the third bucket is what we call portfolio loans. Portfolio loans is your loan does not meet any of these criteria. What else can possibly be done? The answer in a word is portfolio. Okay. Portfolio is where the lender is lending out their own personal money. Okay. Because of that, just like a commercial loan, they get to dictate what the terms are, whether they will do it at all, what the rates are, what the costs are. Okay. Most lenders don't do a lot of portfolio loans. Okay. Car loans are a type of portfolio loan, for instance. There's no secondary market for those. Okay. But most lenders don't have a large appetite for portfolio loans. They're really in it to lend out the government's money and not their own. Okay. Elevations is a little bit different. There's a couple other institutions in the area that are a little bit different. And they do a lot of portfolio loans. Elevations does a lot of portfolio loans. So the lenders retain the loan on their own personal books. They get to dictate what the terms, rates, costs, all that are. So if after all this, you're like, look, there's simply no way to fit inside any of these buckets, the solution may be a portfolio loan. We call those loan committee loans, okay? Loan committee loans. What we would do is we'd get an application, just like we normally start off, get credit pulled. If you don't fit the guidelines and we are a good candidate for a loan committee loan, I will let you know. We'll get that documentation together, and then I literally present an argument to the loan committee. It's a panel of at least 3 credit risk managers or above. They get in a room together, and they kind of weigh the merits of the file. A lot of great examples of this. It's a loan I love to do because it helps people get out of a tricky situation that may not have even been their fault. I had a member, her credit score began with a 4, so it was in the 400s, and this was years and years ago. The only reason her credit score was in the 400s is because her ex was, per the divorce decree and separation agreement, supposed to pay for all these liabilities, credit cards, car loans, personal loans, and he wasn't. So we looked at her credit report and we're like, look, the accounts that are your responsibility have a perfect track record. Perfect track record. The accounts you're still on that your ex is responsible for do not. We did not punish that member for that. So submitted it to loan committee. I was like, I feel pretty confident about it. They came back very quickly and said, yes, we will absolutely do this loan. It's not her fault. It's not her fault. Her ex is a deadbeat. We will go ahead and do this mortgage. Okay. Couple caveats, at least for elevations. It has to be a 5, 7, or 10-year adjustable rate mortgage. They really like the 7-year arms more than the 10-year arm or the 5-year. So they tend to lean towards 7-year arms. The rates do tend to be a little bit higher risk, a little bit higher rate. And typically we have to have 20% down. There's a couple exceptions to that, but typically we have to have 20% down. The reason why is because the mortgage insurance companies' guidelines are going to match what the government's guidelines are, Fannie Mae and Freddie Mac guidelines. So if we have to go loan committee, it's because it doesn't meet those guidelines, which means we're probably going to be ineligible for mortgage insurance. There's a couple exceptions, but for the most part, that's the case. So we literally get a full file together, submit to the loan committee. They will come back and tell us approved, not approved, or maybe restructuring. Hey, we're not good for this loan amount, but we're good for this loan amount. Or, hey, we had to kind of reanalyze how we did it. Debt to income ratios exceeding the government's limit because we have a transitional HELOC, very common. Self-employment, newly self-employed, but they have multiple signed contracts for multiple years that we can point to, very common. We've had a lot of instances where we've done portfolio loans. We've done bankruptcies that were within, the last couple of years, wasn't eligible for FHA or conventional financing, but they had a good reason why. And that is one last kind of takeaway there. When they do these loan committee loans, they are looking for compensating factors. Hey, we might be missing or short on one of these variables, but we have this other variable to kind of compensate for it. If we can show compensating factors, hey, yeah, our debt to income ratio is high, but we have a lot of assets left over, or our credit score is great. If we have compensating factors, it certainly makes them feel a little bit better. They're also really looking for one exception, not multiple exceptions. The success rate when we have one exception in compensating factors is really high. If we have multiple exceptions that we're asking for or lacking compensating factors, the success rate is much lower. I won't submit every loan to loan committee. I have been doing this long enough that I know which loans stand a good chance and which don't. So they'll surprise me occasionally, but for the most part, I kind of know where they are. Awesome. Allison, any other questions? Because that is where we are in our presentation. Time for questions. 3 minutes
I
to spare.
do. Yeah. Right now, I don't see any questions, but then we might get a few here.
We will hang tight for a
Let's
couple minutes to
see.
see if any pop over. If you have any, please let us know. Also, all my contact information is right here on the slide. Cell phone, email, hit me up anytime. More than happy to answer questions. It's my favorite part of what I do, honestly. My love language is active service. So if I can serve you by answering questions, I love nothing more than that.
I do have one quick question. Are there any
Please.
programs for first-time home buyers?
So it's a great question. After 2008 and the housing bubble popped, the government had a lot of first-time homebuyer programs, a lot of them. They were throwing money at first-time homebuyers to help out with the market, buy homes, $10,000 in incentives at one point to go buy homes. When I was a first-time homebuyer, I got to take advantage of one of those programs. It was great. The government realized after a couple of years, they no longer really had to incentivize people to buy. They were just starting to buy on their own. So the government de-incentivized first-time homebuyers and they incentivized low to moderate income household programs. And that's really where the emphasis has shifted. Fannie Mae and Freddie Mac still have a first-time homebuyer program and allows you to put 3% down instead of 5% down. Woohoo! Not a huge deal, right? 2% less, not great. But there is a lot of low to moderate income household programs. There is affordable housing programs, City of Denver, City of Boulder. Every city kind of has their own affordable housing program now. There's down payment assistance through CHFA, Colorado Housing Finance Authority, CHFA, Colorado Housing Finance Authority. That is also not limited first-time home buyers, but it's income limited. So most of the programs now are not necessarily focused on first-time home buyers. They're really focused on low to moderate income household programs. There's also one program through Fannie Mae and Freddie Mac that combines the two. Okay, if you make less than 120% of the area median income, I just looked it up, and Denver Metro is like 156,000 household income for that. So it's pretty high at Bar. It's even higher in Boulder. If you are making less than 120% of the area median income and you're a first-time home buyer, you get preferential rates, preferential mortgage insurance rates as well. So yes, potentially, but it kind of depends. And most of them are now based on you being low to moderate income, not necessarily a first-time home buyer. It is part of our analysis. Whenever we get an application, we start to review it all. It's one of the first things we look at is there any programs we can take advantage of? We're all for it, but you do it a lot. So, great question. 1 minute to spare now. No minutes to spare now. Anything else, Allison?
No, I don't see anything at this time.
Awesome. If you think of anything at all, please let me know. Hit me up, email me. More than happy to answer any questions I can for you. If you have specific questions for your financial situation, we get a lot of that in this seminar when we do it in person. Please, please, please reach out. I'm more than happy to take as much time as I can and help you out however I can. Thank you all so much.
Thank you. Have a great day.